Topic: Share and share capital includes debentures. Following the provisions of Companies Act, Section 43 to 71, Chapter 4. So let me go for the Bar Act first, then I'll come here. Okay. So Bar Act, Chapter 4 deals on share capital and debentures. Start from section number 43 till 72. So 43 to 72 is dealing about share capital and debentures. I'm not going to go for all the headings put together. Here we'll be starting saying as what are the different types of shares we have. Already we have discussed in the earlier sessions. What are the different types of shares we know? One is equity and one is preference. In fact, to say so, when we define the types of capital, one we can say equity capital and another one debt capital. Okay. When we talk about equity capital, we are talking about the shares which can be equity shares or preference shares. Again, if you go under equity shares, that is equity is ordinary shares, ordinary equity shares. Okay, is differential shares with differential voting rights or differential dividend or whatever it's okay. Again, if you go for preference shares, it can be redeemable or irredeemable, cumulative or non-cumulative, okay, convertible or non-convertible, and so on. So 43, we start with kinds of share capital. Actually, when you talk about shares or debentures, actually the beauty of the term shares or debenture is shares we know, but if we go for security, security is a wider term covering shares, debentures, and everything. Okay. If you go for securities, is not defined over here. It's defined under which act? It's not defined under Companies Act. Under which act is defined? SERA. What is SERA? Securities Contract Regulation Act. Okay. 43 is an important section. 44 says, can make it simple, shares are considered as goods. Okay. 45 is a normal section, numbering of shares. Okay. 46, certificate of shares. It's applicable only for physical shares, which is not applicable for demat shares. Then we have to go for voting rights, somewhat an equal or important section, and variation of shareholders right 48. So 43, 47, 48. 49 is an equal one. Calls on shares of same class to be made on uniform basis. What do you mean by calls on shares? If the face value is 10 rupees, this 10 rupees need not be collected at one instance. What you can do? You can do it in different payments, installments or different payments. Usually we go with first case. Before allotment, we'll make a payment for applying the shares called as share application money. Okay, so there will be a separate account open called as an escrow account, and this application money will be deposited over there, and the next amount will be share allotment. After allotment only, see, we have done with chapter number 3. What's that? Only after allotment, share comes to existence. Okay, so share will be allotted. After this will be moved to share capital. Then we may have call one shares, first call. Then we may have second call, or we may have third call. Okay. In addition to that, if you go for the company account side, we'll be talking something called as premium, shares on premium. Okay. So if you are making any call on shares, if it is of the same class, means it should be on uniform basis. Okay. So you cannot have different periods for different types of shareholders. If it is same class of share, means whether it is Ambani or whether it is Yamuna or whether it is you or whether it is another person, it should be same uniform basis only. Okay. Then 50 is company to accept unpaid share capital, although not called up. Yes, please make a note of this 50th section. Probably we'll go in detail. Even though the money has been not called, call one is called. Who usually calls as board of directors, the right authority to call the money. Okay. So call one money is done, which means called. And you are paying call 2 and call 3 money also. Yes, you can. Company can accept unpaid share capital, although not called up. Okay. Then 51 is with respect to payment of dividend. How is payment of dividend done? Usually in two modes. Okay, I'm not talking about the source. Two types. One is percentage on shares. That is face value of shares. Is we can give it as a rupees. I'm paying rupees 12 rupees dividend. What's the face value? 10. But I'm paying 12 rupees dividend. Usually dividend means we have two types of dividend. One is interim dividend and another one final dividend. Usually we use the term dividend one. It can be interim or it can be final. Where with respect to dividend, we'll go in detail in some other things. Okay, not now. Application of premiums received on issue of shares. For what reason you can there is a utilize this premium amount. Okay. Then prohibition of issue of shares on discount, which is 53 is quite important. When we go for types of shares, apart from this type of shares I'm discussing with respect to type of issue. One is directly you can go IPO. One is right shares. Okay. One is bonus shares. One is sweat equity shares. One is ESOP. Okay. We have so many. Okay. Or we can say that GDS are converted to shares or consolidation of shares. We can go in many ways. So that's about 54 issue of sweat equity shares. 55 discusses on issue and redemption of preference shares. I'm not going to continue hereafter. Off writing. Okay. I'll come a bit later. Okay, let me go over the content. Shall I? Shall I take over? Yeah, please join. So first few pages are just the basics only. It's just the basics only. What do you mean by shares? The nature of shares definition is nothing but a share in the share capital and includes stock also. What do you mean by stock? Or the denomination of the shares. And when we say share, it's nothing but proportion of interest. Actually, it's in money only, but we are measuring that in terms of money. What's the right in the company? It's measured in terms of money. Is it okay? An interest in the company is being discussed in this case law. Boland Trustees versus Steel Brothers and Company Limited. So, how do you call the shares and interest measured by sum of money? And what are the rights you have? Is all the rights put together, but not as per the Act, but as per MOA and AOA. But obviously, you have to follow the Act. Act has no overriding effect, but still, you have to follow your company's MOA and your company's AOA. Okay, then contractual rights and legal rights for shareholder. This is how we can define a share. Section 44 says it's nothing but a movable property. It's not talking about share. It's talking about movable property, saying that it's movable and it's transferable as per AOA. It's not only talking about shares, it's talking about debentures also. Please make a note. Please make a note. Please highlight. It's talking about debentures also. Is it okay? And other interests. What are the things involved in this? Numbering of shares is done in section 45. You remember? We were referring to the Bar Act. Section 45 discusses on numbering of shares. So numbering of shares distinguished by distinct numbers and is not applicable for demat shares. What do you mean by demat shares? Holding in soft form. Okay. Numbering is applicable for physical form of certificates, shares. Okay. So when you talk about soft forms, we talk about demat shares. What do you mean by soft form? If you don't understand, you just give 1 lakh to me today and I'll give some other 1 lakh to you. Okay. What do you mean by some other 1 lakh? I'm not going to hold the same currency notes. That may be different currency notes, but you will get your 1 lakh. That's what softcom or that's what dematerialization of shares. You will not get the same currency numbers or same currency notes, but your money is there 1 lakh. You may get it in any form. Is it okay? Okay. You're doing some online payment. Okay. How much you're going to pay? Actually, when we go for this carry currency notes and coins, if there is a bill for this amount, 12.25 paise, how much you will pay? Okay, definitely I'll not pay 13 rupees. Okay, I'm strong enough to pay only 12 rupees. In case you're making GPay. Okay, how much you're paying? Tell me which form is better. Better pay in cash. 2 minutes. Okay. Actually, this is a beautiful form. When we talk in DMAT form, we'll get the exact numbers and exact figures. Okay. Even though we are not talking about like notes or distinct numbering, it's a beautiful form. Okay. What's the highlight of shares and stocks? Is often repeated question. Shares means it can be measured in terms of money. That is the sum of money. It's all your rights, measuring your rights. Okay, that's what is the rights you're carrying on. So bundle of rights, not only rights. Please have a note. Liabilities. When we talk about rights, we are talking as per MOA and AOA. Remember, we are talking as per MOA and AOA. What MOA says? It's a company limited by shares. What MOA says is a company limited by shares and guarantee, which means Accordingly, your liability also changes. Is it okay? So interest and mutual convert, it's a right in profit, which means you can get the dividend, and we'll follow the going concern and winding up concept. What do you mean by winding up is once my company owns up, then automatically what are the things I am having interest as a shareholder? I'll get it. Again, comes here, whether you are your equity shareholder or preference shareholder. Preference shareholder, as per the definition, it gets the preference. The shareholder gets a preference. Preference when? During the winding up. Okay. And when you go for stock, it's also sum of money, but you cannot exactly say it's a bundle of rights. Okay. Probably you can say no bundle of rights. Because when we use the term shares, we call it as, please highlight this word buffer. It's not bundle of rights, it's a sum of money. It's not a debt, and we do the numbering also, okay, as usual. Actually, we cannot go exactly saying directly we have something called a stock. When we go for consolidation, you remember when we were altering the share capital clause. What you can do, you can consolidate and split, which means 10 rupees face value can be splitted as 2 rupees face value share. So what we do is I hold 10 shares of 10 rupees. Okay. So how much worth I'm shares I'm holding? 100. So before converting this as 2 rupees face value share, is first converted to stock. Then it is splitted as 2 into 50 number of shares. Okay. That is 2 rupees face value and number of shares is 50. In case I'm taking 10 into 10, which is 100, and I'm taking this full 100 rupee share as one share, that is face value 100, which means actually I have to make it as stock. This is how it has been applied. So if you refer for any companies, which company has converted shares to stock will not get this direct one. Either it has consolidated or it has split it, subdivided. Only in those cases you'll get it. Okay. So let me continue. Now let me go for section 43. Let me go for Barat first. Please join. Section 43 from the Barat. Okay. The heading itself is kinds of share capital. How it starts is the share capital of a company limited by shares shall be of two kinds. So actually it's classifying the share capital. Namely, A, equity share capital, then where is B? There only. Okay, I missed it. Oh, here. Oh, here. Sorry, I missed it. Okay. So B is preference share capital. A and B. So it starts this way. 43A, then B. Under A, which is under equity share capital, you have two types. One is ordinary, that is with voting rights, and another one is differential voting rights. So under this, you have 1 and 2. Okay, this is how the presentation looks here. Then we go for preference share capital, which is following from 43 subsection B. Okay. Below that, we have explanation. Explanation carries a lengthy part. Okay, let me go for this one. Now from single material. So kinds of share capital, nature of a company, for which company is applicable? Company limited by shares. So if this is your question in your exam, how are you going to present this? How are you going to present this? Now you know the Bar Act, right? The share capital of the company limited by shares shall be of two kinds. But how I have presented here, company, it's applicable for company limited by shares with two kinds. So this is how we can frame the sentence. You cannot directly mug up from the Bar Act, but you can apply all the section numbers and all. So what is section 43, subsection A says? Equity share capital with voting rights. I have added some content extra. When you talk about equity share capital, it can be issued at par or premium or discount. Actually, again, when you refer Companies Act, it says issuing at discount is prohibited, but for sweat equity shares or under some specific plan or scheme, it can be done. For ESOP and other things, or not, it can be done. Generally, it is prohibited. What do you mean by discount of shares? Paying less than the face value. If the face value is 10 rupees and you are paying less than the face value, It's what you call as discount on shares. If you are paying at par, which means equal to face value. If you are paying at premium, means more than the face value. Okay. Next, with respect to subsection 2, there is subsection clause 2. It is with differential voting rights as to dividend, it may be. How you are differentiating? With respect to dividend, or it may be with respect to voting, or otherwise equity share, equity shares with differential voting rights, whatever it can be. Which means with voting share, you can do, but no conversion. First, in the beginning, you give it as one share. It should not be converted later. With differential voting rights or dividend, you can give it. It should be as per the AOA. If it is not as per the AOA, what do you do? What do you do? It's not provided in my articles of association of my company. What do you do? What do you do? Nothing. We'll amend it. Okay. Probably how you do the amendment with respect to articles of association is ordinary resolution is enough. If you go for memorandum of association, you have to go for special resolution. Here, ordinary resolution is sufficient. But postal ballot may be required. Okay. When is postal ballot required? I already discussed. When is postal ballot required? When there are 200 members in a company. At least 200 members in a company. So tell me, whether private company has to go for postal ballot for amendment. I have given the answer. When you require postal ballot, when at least 200 members. So for a private company is applicable? No. Only for public company. When it exceeds 200 members, we need to go for postal ballot. Okay, only for public company will go for postal ballot. Okay. And what type or what percentage of shares you can issue as differential voting rights is not less than 26% of post issue. What do you mean by post issue? Is after issue I have to check. And not only that, the company has to maintain a track record with respect to showing profit for the past 3 years or whatever it is, and it has to do some proper filing, annual returns and other things. Okay, follows from section 92. Not only that, it should not be penalized from any court or tribunal on non filing of financial returns, the final returns. Okay, non-payment of dividend is there, or redemption is not done, or redemption of deposit is not done, redemption of debentures, deposit, everything comes in. Generally with respect to debt capital, and not only that, also with respect to interest, which means we have redeemed the deposits. Okay, you have redeemed the debentures. Also, you should have paid the interest for deposits and debentures, and whatever the bonds and other things are there. Okay. So if your company is penalized on this basis in any court or national law tribunal, company law, national law tribunal, then this company is not eligible to issue this differential voting ratios. Example, you can just go through. We have done already with Tata Motors. Please. Let me go for subsection B. Deals with preference share capital. The term itself says they are preferred. Who? Almost like owners, they are preferred, but only in some cases they are preferred. Especially when we go for paying dividend. Okay. Paying dividend, they get the complete rights. Even though there is no profit, you have to pay the dividend. There is no profit, there is no surplus also, there is no reserves. How the company can pay the dividend? In the case of cumulative preference shares, if the dividend is not paid for continuous 3 years of time, automatically then this one cumulates. You might have heard this term called as arrears of dividend, right? So this term cumulates, then automatically they'll get the voting rights, which means from 43 subsection A, only equity shareholders get the voting rights. They don't have the voting rights. Go for the very first line. I'm following from Bar Act. What does the very first line says here? Equity share capital with voting rights. The very highest right to have is voting rights. In all the cases, you'll get the right as an equity shareholder, but not as preference shareholder. That's a very big difference between equity shareholders and preference shareholders. Okay. So you'll get the right to participate in the proceeds when during winding up. So surplus of profit or assets, you'll get right on it. Capital shall be deemed to be preference share capital on which basis? With respect to dividend and capital. Two ways. Voting rights only when dividend not given, you'll get the voting rights. That also for which shares? We can have a note on here. That is also applicable for which shares? Cumulative preference shares. Okay. Types of types of preference shares on the basis of redemption, on the basis of accumulation, On the basis of conversion, you can classify. On the basis of redemption, redeemable or irredeemable. On the basis of accumulation, cumulative or non-cumulative. On the basis of conversion, convertible, non-convertible. Convertible means you convert into equity shares in the future. Non-convertible, no, you cannot convert at all. Cumulative, the arrears of dividend will be cumulated and along with the voting rights, you have to pay the dividend. Non-cumulative, no. If that year dividend is not paid, is not paid. Okay, you know that when we say dividend, okay, when we say, let me go on this angle. On two shares, one is equity and one is preference. When we say dividend, dividend has this definition called as appropriation of profit, right? For preference shareholders, even though it's called as appropriation of profit, it will be called as charge on profit, which means it's mandatory for the company. The company is liable to pay the profit if it is a preference share. Okay. Here for equity share, it's not a must. Only the board of directors recommend they can do. It's only in the hands of board of directors. Interim dividend, directly the directors can pay. For the final dividend, they can recommend so that in the balance sheet you get it as proposed dividend. You might have seen this term, right? Proposed dividend in the balance sheet. What does it mean? The board of directors has recommended and the financials are made ready after the AGM, which has been considered for this as a one of the meeting. Sorry, one of the business. It will be considered for confirmation of the dividend. Okay, so till that in the balance sheet, it will have the value as proposed dividend. Where will you find this proposed dividend item? Where will you find this item proposed dividend? The profit or loss account or balance sheet? General question only one. Okay. Yeah. Liability side or asset side? Liability side only. It's a liability for the company. Okay. See, even though it's a liability for the company, the term is proposed dividend. Till it's confirmed, you cannot say it's a complete liability. Okay. So, proviso, if they are entitled to participate in the process of filing up before the commencement of the act, normally explanation. Now here, see, only this one till here is the section 43. All the remaining parts are explanation. Usually, when we talk about act, when we talk about an act, any act, not only Companies Act, what happens is it will be clearly giving section numbers. The very first line will be preamble. What do you mean by preamble? Is the short summary of the act, what the act talks about, it will be given. Then all the section number arrangements, everything will be given as a content. Okay. After that, it starts with saying all the section numbers in detail. Sometimes you'll have explanations, sometimes along with that you'll have illustrations. Okay. It will be there applicable in the paragraph. Sometimes seeing the provisions will not be able to understand. Even though you are a CA, CMA or CS, the interpretation might not be very easy. The interpretation may cause some difficulty to understand. So what we'll do is, usually all the three professionals will do. Usually what we'll do is, we'll represent to the board saying that we are not clear with this provision. Very debatable. Okay. See, in my angle, it may be sensed in a different way. In your angle, it may be different. So many cost accountants, company secretaries, and chartered accountants are there. Each and everybody will be discussing in different angle. All the meanings will be rightly chosen here, which means interpreted correctly. So what the act is actually talking about. So what they'll do is they'll add some notes, just explanation and illustration. Explanation means they are explaining. See, for example, first point under explanation, what do you mean by equity share capital? With reference to any company, any means not any. Okay. I mean, I discussed this was CS students. Any means not any. Any means under this condition. Any company should be limited by shares. Here means all share capital, which is not preference share capital. Which means it can be equity share capital with voting rights, with differential voting rights, everything, but not preference share capital. This is for which company it's applicable? Limited by shares. This is what you call as explanation. When you go for illustration, they'll mention A is a company, etc. That will be taken as illustration. There's a lot of difference between explanation and illustration. Is it okay? So what's the second one? Preferred share capital means that part of the issued share capital. Please highlight this word. Actually, it's available in single material. So probably let me go from here. Part of the issued. You can highlight. Issued share capital carrying preferential right. What type of preferential right? With respect to payment of dividend each and every year and repayment during the winding up. Did we discuss this term waterfall arrangement? Any idea about this? I have discussed this earlier, waterfall arrangement. So whenever the company goes for winding up, liquidation process will be carried on. Okay, you know these terms, winding up, or let me go for a board. I might have discussed. I might have discussed this already, but let me have a quick glance on this. So we have this term called as winding up. Okay, we have this term called as dissolution. We have this term called as liquidation. Okay, what do you mean by winding up? Is actually winding up is somewhat equal to liquidation only. When we say winding up, we are going to close all the assets and pay off the liabilities. How do you do this? By a process called as liquidation. So liquidation is a process. Winding up is a state. What's the state of the company? The company is winding up. Okay, kadai katranga. Okay, that's the meaning. But it doesn't mean it's dissolved. What do you mean by dissolution? Closed. Dissolved. Over. You take a glass of water, you put a tablet or something inside, tablets of some granules of some powder inside. That's a company like. You put it in the water. That is a glass containing water. What happens to the granules or tablet or anything like that? What happens? It dissolves. Can you clearly identify which is company? No, you cannot identify, which means it's closed. So winding up is something, the earlier process for dissolution. Now tell me, when a company wants to dissolve, is that necessary the company has to wind up? Is a mandatory one? It has to go for wind up? CA students, இப்பதான் நீங்க amalgamation படிச்சிருக்கீங்க. Just now you studied amalgamation. Okay. What do you mean by waterfall arrangement? It happens in the case of liquidation process. Okay. It happens in the case of liquidation process. First, to whom you have to pay the amount. After finishing all or liquidating all the assets, first to whom you have to pay the asset? To the statutory dues. Probably like salary to the employees, PF, gratuity, okay, that fee, tax, and even for the liquidators fees, all this has to be paid. This is the very first layer. Second, to whom? Secure creditors. Okay. Third, then the unsecured creditors. Then the preference shareholders. See, this is the point we are discussing here. For the preference share capital, they are preferred during wind up, which means all of these three persons or these three levels are preferred first. Then only they are preferred. Then why we are using the term preferred? Preferred means they should have preferred first, right? We should give preference for them first, right? But we are not giving preference here. Actually, only at the fourth stage I'm giving the preference. Which means there is another one stage where the preference is given at last for the equity shareholders. Now you have to give importance only for these two persons. They are the owners, like. So preference is given to equity shareholders or preference shareholders? Preferred. That's why they are preferred over the equity shareholders. So first preference is only for these only. Okay. Yes. Let me carry on. So waterfall arrangement. Here where I'm. So with respect to payment of dividend, it is discussed under A. Explanation 2 under that A. Payment of dividend. What do you mean by payment of dividend? A fixed amount will be given or an amount calculated at a fixed rate, which means percentage. 5% on face value, 10% on face value, and so on. Which may either be free or subject to income tax, TDS. B. Repayment. When we go for winding up or repayment of capital. The amount of share capital paid or deemed to have been paid up. Whether or not there is a preferential right to the payment of any fixed premium on any, you might have studied this heading, right? Redemption on premium, the same content. Okay. Third heading, capital shall be deemed to be preference share capital, nothing that is either entitled to either or both of the following rights, namely with respect to dividends or with respect to capital. This is about section 43. Can you go through once, please? Sweat equity shares. Just go for a fast glance. Then we'll go for as per the Bar Act. It's meant for IPR. What do you mean by IPR? Intangible assets, intellectual property rights, issued at discount or consideration other than cash. To whom? To employees, where the employees are, maybe in India or out of India. Please take care of this note, which is the employees can be out of India also. Okay. And those should be employees for at least 1 year in my organization. Okay. They should be associated with me at least for 1 year in my organization. Includes directors also, please highlight. To whom I can issue certificate shares? To directors. Directors means we have so many directors. Independent director, non-independent director, executive director, non-executive director, small shareholder director, nominee director. We have so many directors here. Directors includes full-time director also. Okay. Why particularly there is a mention about full-time director? Any idea? See, directors is understood. Why we are particularly mentioning about full-time director is full-time director is considered as an employee for a company. Not all the directors are employees of the company. Whole-time director or executive director, we call them as employees of the company. See, here we have already mentioned two employees. Here we are mentioning director. Now, when we talk about this whole-time director, tell me whether he is an employee or whether he is a director. By name, he is a director. By status, because it is whole-time, he is an employee. Now, for my company, as a company secretary, I am planning to issue this sweat equity share. Okay, to whom? To employee. Now tell me, Mr. X, who's a whole-time director, will be covered under this definition. Yes. Because whole-time director carries both the status, employee and director. In case there should not be any argument saying that he's a director, so he should not be considered as an employee. That's why there is a particular mention about director includes full-time directors. And please make a note, there should be a lock-in period for 3 years. And also when we talk about the employees or the directors, they need not be employees or directors of this company. They can be for my subsidiary company also. So H company is there, holding company is there, subsidiary company is there. This company is going to issue sweat equity shares. What else? So, subsidiary company directors and employees are also eligible. Okay. And they will maintain a register in this case, which is called as SH3 for record purpose. And the resolution has to be passed where this resolution will be valid for 1 year from the date of passing of the special resolution and after 1 year from the date of commencement of. Okay. And when you go to the financials, it will clearly mention what type of shares you have issued and to whom you have issued and everything. Okay. And before issuing this particular shares, a policy will be defined for whom this is being covered. Okay. For what is being issued? For IPR. If there is a director, Mr. X, he has brought business to the company. See, IPR is not only IPR for know-how, royalty, etc. He has brought business into my company. You can take everything. Okay. In the record, SH3, for what purpose you have issued this vetting share must be mentioned. Is it okay? So that's about vetting share. Now we directly follow the applicable provision from Companies Act, Section 54, deals with issue of sweating editions. Subsection 1. Notwithstanding anything contained in Section 53. What is Section 53? Join with me. What is Section 53? We should not forget the section. Whenever we talk about Section 54, we have to talk simultaneously about Section 53 also. Section 53 says prohibition on issue of shares at discount. What Section 54 says? Notwithstanding. What do you mean by the term notwithstanding means? என்ன வேணா 53ல சொல்லியிருக்கிறோம் இங்க 54 வந்துட்டீங்களா 54 தான் அப்படி ப்ளீஸ் ட்ரை டு அண்டர்ஸ்டாண்ட் என்ன வேணா சொல்லட்டும் and then at section 54 then section 54 only apply, which means section 54 has a overriding effect on section 53. You may expect this question as an exam in your exam paper. Section 54 probably you can make a note of here somewhere. You can highlight this line and you can say section 54 has overriding effect on section 53. Is it okay? So which one is prevailing? 53 or 54? 54. 54 is for what case? Sweaty beneficiaries. 53 general. 54 on sweaty beneficiaries. Is it okay? issue of shares, you cannot issue a new class of share, but instead the class which have already issued, you can issue it now. So already you have issued 10 rupees face value. Yes, you can issue. Still so far you have not issued 2 rupees face value share. Then you cannot now issue as sweat equity share. Okay. So it should be already the class issued. What are the conditions to be fulfilled? Simple bump. It should be authorized by special resolution. There should be specification, which is the content. Okay, you can make a note of it. The content, number of shares, what is the current market price? Because you're going to issue a discount, right? So you need to know what is the current market price. What is the consideration for the which class or classes of directors is applicable, to which employees is going to be applicable, etc. If it happens to be a listed company, then just close your eyes and tell you are following SEBI regulation. Whenever you go for listed company, along with Companies Act, you have to go for SEBI regulation. Whenever there is foreign currency involved, along with this one, you have to go for following FEMA. That's it. Okay. Continuing. So subsection 1 is over. Subsection 2, pari passu shares, which means I have issued some 1,000 equity shares in the year 2012. Now, another 1,000 equity shares, sweat equity. I'm talking about sweat equity in the year 2023. Okay, my company is formed in the year 1990. At that time, I have already had 1 lakh equity shares. So 2025, right? So today, I'm issuing this 1,000 number of sweat equity shares. I cannot say this is new share. This is equivalent to this share. This is equivalent to this share. This means all shares are treated at par. Okay, this is what you call as pari passu. Okay, pari passu shares with respect to rights, limitations, restrictions, everything will be carried over and it will be taken as part to other equity shares. So, which means the shares holded by these persons, the sweat equity shares holded by those persons and other equity shareholders will get the equal rights. Okay, that's about section 52. Section 52 is a small section. 53, prohibition on issue of shares at discount. Very first section strongly it says no shares shall be issued at discount except sweat equity shares under section 54. See, join here. Join here. Except as provided in section 54, a company shall not issue shares at a discount. So if you get this question, please try to write it this way. It's easy only. We are not going to memorize. But usually when we talk about saying a bad ad, it starts like anything, sorry, not anything, notwithstanding, provided that, except, saving clause, we'll have all these formats. So just try to remember all these formats. Okay. So that's about one. With respect to two, if you are issuing, which means you are not following these provisions of the act, then it becomes void. To be very particular, it becomes void ab initio. Probably can make a note of it. It becomes void ab initio because it's not there in the law. Okay. And there is 2A, notwithstanding anything contained in 53.1 and 53.2, shares shall be issued at discount to the creditors. When we say any other plan, that plan may be involving statutory resolution plan. Okay. So when it happens to the creditors, what the creditors will do here is they will go for, in case the company is going for liquidation, probably insolvency case or whatever it is, the creditors, there is something called as IBC. You remember what is IBC? Insolvency and Bankruptcy Code. Under this IBC, a committee of creditors will be formed. In short, we call this as COC. Committee of creditors will be formed and they will be designing a plan called as resolution plan or something called as debt restructuring scheme will be done. Okay, so this is following from section 53, subsection 2A bar. Okay, this will be done in accordance with any guidelines or directions specified by RBA under this Act or banking regulation. Is it okay? Fine. Let me go for 3, subsection 3, contravention. Company and officer in default will be liable for the amount raised through the issue or 5 lakh rupees, whichever is lesser. Additionally, the company has to refund the received money with how much interest? 12% per annum from the date of issue of shares to the person to whom such shares have been issued. So it's called as dual penalty. One penalty basically for the company and officer in default. In addition to that, the company has to refund the money. Whenever we talk about penalty, we'll get dual penalty, one for the company and another for officer in default. In addition to that, this is actually not penalty like you have to refund the money, but along with the interest is there, right? That's why we call this as penalty. Okay. Shall I take over? Next heading, securities premium account. Any single penny amount greater or above the face value is what you call as the premium collected on shares, and that has to be deposited in a separate account called as SP account, in short called as securities premium account. Follows from section 52. Directly we are going to cover section 52 subsection 1. Transfer a sum equal to the aggregate amount. Probably you might be knowing what this, because we might have done this in companies accounts. Okay, so aggregate amount of the premium received on the issued shares, whether in cash or otherwise, except as provided in this section, is applicable on reduction of share capital with respect to securities premium account treated as paid up capital. Please highlight this. Consider as paid up capital. So I just given a small example. Issue price is 12 rupees. Face value is 10 rupees. So the premium is 2 rupees. Number of shares issued is 1000. So how much amount you are going to transfer here? 1000 into is transferred to. Okay. With respect to subsection 2, for what purpose we can use this securities premium account? Under which heading you will find this account? You will find this in balance sheet. Under which heading you will find it? Whether it will be available in the balance sheet is not a face item. It will be available under reserves and surplus. It is not a face item. Okay. So தெரியாம போய் தேடாதீங்க. Securities premium account உள்ள notes consider. Okay. Notwithstanding anything contained in subsection 1, for what purpose you can use it? Towards fully paid bonus shares. So you're going to issue bonus shares. You can utilize this amount. In writing of the preliminary expenses of the family, what do you mean by preliminary expenses? Preliminary expenses has another name called as pre-incorporation expenses. This also will be available in the balance sheet. Okay. Pre-incorporation expenses, which means the company is incorporated at this particular date. What are the expenses spent by the directors, which means proposed directors or the promoters of the company? After the company is incorporated or during the incorporation, all this vetting work will be done, right? In the articles of association, there will be a mentioning in the clause saying that all the money can be reimbursed, which means the preliminary expenses can be reimbursed to the respective person, promoters or proposed directors or whatever it is. This amount is what you call as pre-incorporation amount. Tell me how the company is going to repay this amount. Only today the company is formed, not has started the business. How it's going to repay? What law says is with respect to preliminary expenses, you can hold till the winding up of company. It's not an issue, which means it's not necessary to repay it immediately. You can repay at any point of time. Or else you can use this amount for writing off the commission or discount on shares of debentures. Premium, reduction on premium with respect to preference shares or debentures. Is it okay? Purchase of his own share or other securities under section 16. Okay. They say something called as buyback of shares. Actually, we should not mention buyback of shares here. It's purchasing of its own shares. Okay. For these purposes only, you can utilize this securities premium. Tell me whether you can utilize this amount for dividend. You should not get confused. What the access? Only for these 5 purposes. Is it mentioned dividend here? No. Which means you cannot utilize. Your question will be asked in such a way. There's a company ABC Limited, the chartered accountant wants to, or the cost accountant or the company secretary wants to utilize this securities premium amount for payment of dividend, etc., etc. Okay, question about confused. You will be thinking as if you are not studied properly. No, you have studied very properly, only for 5 purposes. Okay, 5 purpose means if you go keenly, it will be mentioned as the first point for fully paid up bonus shares, writing of preliminary expenses. It will be mentioned as commission separately, discount separately. It looks like third point and fourth point. Probably commission for shares, commission for debentures. Discount for shares, it will look like 5 and 6 points. It will look like as if you're writing so many points. No, make it simple. Okay. Redemption for preference shares, debentures, purchase of his own shares or other securities. So just make it simple, 5 points. Okay. Shall I go for subsection 3? Notwithstanding anything contained in this one and this one, applicability to apply by such shares, okay, as may be said, towards fully paid up shares, they have to comply with the financial statements, right of commission or discount, and purchase of his own shares or other securities under section 68. Notwithstanding anything contained in subsection 1, The SP account may be applied by the company. Which company? The company. What do you mean by the company? The company which has issued shares on premium. It's applicable for all the company which has issued shares on premium. What the third point says is the securities premium account may, notwithstanding, with respect to subsection 1 and subsection 2, which means even though it is said in subsection 2, for such class of company, you can apply the amount only for these three cases. Okay, as may be prescribed, or whose financial statement comply with the accounting standards under section 133. So whenever the company goes for financial statements and other thing, we have to go for complying with accounting standards and we have to follow section 133 the same way. So only for those company, only these three is available. Only these three applications are available. But whereas generally all the five may be available. Okay. So here towards the share issue of unissued shares as fully paid up shares, for issuing bonus shares for preliminary expenses, commission paid or discount allowed on shares and debentures, premium payable on reduction of any redeemable preferred shares or debentures purchase of his own shares. But whereas we go for this one for bonus shares, for writing of the expenses or the commission paid, etc., or purchase of his own shares. The other two are not available. Okay. Buyback of shares. Applicable provision is section 68. Actually, the section 68 is a beautiful section. It gives the power for the company to purchase its own securities. Buyback of shares is nothing related to the direct issue, but already issued the shares and we are going to take back, which means we are taking back the own company. We cannot use the term as purchasing our own securities, but the applicable provision 68 says you can purchase your own securities. Okay. See, not only my company, if this relationship exists between two companies, holding and subsidiary, even subsidiary company cannot buy shares in holding company. There's a restriction over there. Okay. Holding company will hold shares in subsidiary company. How much shares? At least 51 shares. Okay. In turn, subsidiary company is having 51% shares. Now tell me which is holding and which is subsidiary. There are no such provisions. It cannot hold. There is a prohibition for a subsidiary company to hold shares in holding company. On behalf of a trust or something like that, it's holding with that's different. But directly, in case, without some misunderstanding or something like that, without the knowledge, the holding company has issued the shares to the subsidiary company, means that will not be applicable. Law prohibits that the holding company should not issue shares to the subsidiary company, or the other way, subsidiary company should not buy shares in the holding company. It will not be considered. It's void. Okay. Explanation goes with two terms, specified securities and free reserves. Specified security includes ESOP, employee stock option plan. Either we'll use this one, ESOS or ESOP. More or less both are the same only. SS scheme and PS plan. And otherwise the central government will be notified. When we talk about free reserves, we'll be discussing about securities premium account also. So notwithstanding anything contained in this act, but as per this subsection 2, a company may purchase its own shares or the other specified securities. Hereafter, we'll be referring this as buyback of shares from which sources? Free reserves, securities premium account, or the proceeds of the issue of any shares or other specified securities. Which means I can issue some other shares and I can utilize for this one. Okay, three sources. For which is not applicable, please highlight buyback from the process of an earlier issue of the same kind of share is not applicable. Already have issued the same kind of shares. Now we are going to buy back the same kind of shares. Why are you doing this? Okay, you should not do it, right? Am I right? The company is in need of some capital. Okay. What is this company doing here is, it's raising amount for some 1 crore rupees. Okay. Of class A share. Okay, to give more specific content, I go for class A share. That may be of any type of share. Now, with the help of this 1 crore capital raised, the company has done the business and is succeeding it. Now the company goes for buyback of shares. Whether this company can go for buyback. That's about this content is. Buyback from the proceeds of an earlier issue of the same kind cannot be done. Go for this third point. First one, I have reserves in my account. I can utilize it. I already have this SP. I can utilize it. But what about the third one? I have to raise an amount by issuing the shares. Issue the shares. Which shares? The same class A shares. Why? To buy back the same class of shares. See, what's the logic behind this? The purpose why you issue this, you're going to do some business is fine. But the purpose you're going to issue here is to buy back your own shares. It's like cancelling the terms. Like it's not necessary. It's not necessary. It's prohibited. So it's not applicable. Buyback from the process of an earlier issue of the same kind of shares is not allowed. It's prohibited. That's why we say it's not applicable. Provision. Okay, condition. Okay. With respect to subsection 2, what are the other conditions should be there? We should be authorized in articles of association. If not, what do you do? If not, amend. Amending is very easy. We should be there in articles of association. Okay, let me go for this discussion. It's there in MOA. Okay. See, I'm going for general content. It's there in MOA, but it's not there in AOA. What do you do? It's there in MOA, it's not there in MOA. What do? You amend AOA. Okay. There is something called as ratification. You know what is ratification? Some unauthorized act is done, and that act is need to be accepted now. If accepted, it was act is ratified. So it is not there in MOA. Sorry, it's there in MOA. It's not there in AOA. Ratification is possible. But when you go for this content, buyback of share is nowhere stated in MOA. Usually we talk about amalgamation and other things as well. We know this object clause, two types of object clause we have. One is main and one is ancillary. Main object is the direct what type of business I'm doing. Ancillary is something what the company may be involved, buying loans, amalgamating another company. Buyback provisions will not be there in articles of association. So what you have to do here is you have to authorize an articles of association, then only you can do it. Because already it's not there in MOE. So directly you cannot go for ratification. Please try to understand. If it is not there in AOA, you have to ratify it. Sorry, you have to amend, then only you can proceed. But if something is there in MOA, it's not there in AOA, you can ratify. Okay, you can do that. Under MOA, there is a clause with respect to amalgamation of companies. A company and B company are amalgamating. It's there in MOA, but the provisions are missed out in AOA. Whether you can amalgamate, is you can amalgamate. You can ratify and do it. But what about buyback? Buyback is definitely not be in MOA. So what you have to do? First step you have to amend in AOA, then only can proceed. So this authorization is very, very important. We may expect this question here. Okay. If there is not in articles of association, please amend the articles of association, which means the very first point, A point of subsection 2 has to be satisfied, then only can proceed. And after that, what you have to do? You have to go for passing, that is conducting an AGM or EGM, then go for passing a special resolution proviso, where it is applicable. Not applicable if buyback is less than 10% of paid up equity plus D reserves. How much your buyback? How much you're going for buyback? Not applicable if buyback is less than 10%. 10% of what? Aggregate of paid up equity and free reserves. We have to discuss this angle. When we say equity in general, it means, okay, when we say equity, it's equity shares only. When we say preference, it's directly meant with preference shares. When we say share capital, it is both equity and preference. Somewhere please make a note of it. When we say equity, it's directly equity shares. When we say preference shares, it's directly meant for preference shares. When we use the term share capital, it is meant for both equity share capital, preference share capital. Okay. See here, first point under proviso, first proviso. If buyback is less than or equal to 10%. 10% of what? Paid up equity, which means we are talking about equity share capital, paid up equity share capital, and authorized by board resolution. Buyback is less than or equal to 25%. Here, paid up of equity and also preference. Because in the act is mentioned as only capital. If it is mentioned as paid up share capital, what does it mean? Both equity and preference has to be considered along with free reserves. So in reference to this 25%, it has to check total paid up equity in that financial year. Okay. Which shares are going to buy back? Equity shares or preference shares? When we go for preference, we use the term redemption. When we go for equity, we use the term buyback. So, which shares are going to buy back here? Total paid up, equity capital only are going to talk about 25%. But while calculating the 25%, you have to calculate with respect to paid up equity and preference. Okay. And the debt is to equity ratio. Debt by equity should not be greater than 2 by 1. 2 is to 1 ratio. Here, when we say debt, we are talking about secured and unsecured debts owned by the company after buyback. After buyback, not before buyback. After buyback, you have to check whether this ratio is maintained. Then, equity, paid up capital plus free reserve. What does this equity means? Paid up, so probably you can have like a ratio form. Secured plus unsecured debts after buyback. Okay, after buyback by denominator equity paid up capital, which means equity paid up capital and preference paid up capital plus free reserves. You check this ratio, it should be of what? Not greater than 2 is to 1, which means if this amount is 1, this should be maximum 2 only. Not greater than 2 means what? Maximum should be 2 only. Which means if this amount is 100 crores, what should be this amount? Not more than 200. It can be 190 crores, 180 crores, or whatever it is. Okay. Or sometimes central government may be notifying a higher ratio. So E point, shares or other specified securities for fully buyback should be, for buyback should be fully paid up. If it is partly paid up, convert to fully paid up first. If listed in recognized stock exchanges, go and follow SEBI regulations. If not listed, just follow the prescribed rules. No offer to buyback shall be made within a period of 1 year from the date of closure of the preceding offer of buyback. Already there is a buyback, and that itself is not over. 1 year is not over. You cannot go for next buyback. Okay, there should be a solid gap. Can you go for this provision, please? It's not yet over. 68, section 68, subsection 1 starts saying that notwithstanding anything contained in this act, but subject to the provisions of subsection 2, which means what? When you go for talking about subsection 1, you have to keep in mind the provisions related to subsection 2. Okay. A company may purchase its own share or other specified securities. Here and after, you can call this as buyback out of free reserves, securities premium account, and process, provided no buyback of any kind of shares or other shall be made out of the process of the earlier issue of the same kind. Okay. When you go for second subsection, it starts no company shall purchase its own share or other specified securities, etc., unless it should be authorized by articles. A special resolution has to be passed. Usually, when we talk about ordinary resolution and special resolution, it should be passed in general meeting. The general meeting can be annual general meeting or extraordinary general meeting. And that resolution has to go for authorizing buyback. Provided that nothing contained in this clause shall apply to a case, which means you need not go for AGM or EGM. See, when is this special resolution required? To understand this, when the special resolution not required should be understood. So when it's not required, that's a provision, which means non-applicability of this subsection. It says if the buyback is less than, that is 10% or less than that. Now I'll come here. See, what is A? It should be authorized in articles of association. What is B? Special resolution is passed. I don't know how far you check with this alignment. This is aligned inside this one, which means what? Special resolution is not required, which means if buyback is less than 10% and authorized by board resolution. So it's enough that you go for authorization board resolution. Then C is completely different. How much you can buy back? Up to 25%. Now come back here. See, the buyback is 10% or less than of the total paid up equity capital and preference. It's about equity. Such buyback has been authorized by the board by means of resolution passed at this meeting. Now we go for C. So this 2 is over. Now we go for C. The buyback is 25% or less of the aggregate of paid up. It's given only capital, which means paid up equity and preference. So paid up equity, paid up preference plus free reserves. All the things to be three things to be added, etc. etc. Okay, here. Now D. The ratio of the secured and unsecured debts owed by the company after buyback is not more than twice of the paid up capital and its free reserves. Debt by equity is equal to 2:1 ratio. 2 by 1. Now cross multiplying. Debt is equal to 2 times of equity. இதான் மேக்ஸ் ஃபேக்கல்டி வந்து லா எடுக்க கூடாது. Debt is equal to 2 times of equity. So now read this line. Second point, the ratio. Ratio means what? Numerator by denominator form. Ratio of what here? Aggregate of secured and unsecured debts owned by the company after buyback is not more than. That's why I was using debt is to equity is not greater than 2:1. Okay. Is not more than twice the paid up capital and free reserve. Please make a note here, paid up capital is equity and preference. Okay. Provided the central government may notify a higher ratio. Hope is now okay. Usually first glance you need not understand. Now go through in this angle. Now you read this provision once again. Yes, please. This is there available in your material. Probably if you want to compare with Bar Act, you can compare. Yes, please. With respect to subsection 3, whenever you go for special resolution, not only for special resolution, usually we have two types of business in AGM. You know, what is? One is ordinary business and another one is special business. Ordinary business are 4 types. One, adoption of financial statements. Probably we have this content in the later period. If you are not aware of this, don't worry. Okay. One is adoption of financial statements. Okay. Second one, what? Confirmation of the dividend recommended by the board of directors. Third one, appointment or reappointment of auditor and appointment and reappointment of directors. These are the 4 business. Apart from this business, any other business you do, which you require ordinary resolution or special resolution, you need to give an explanatory statement. Why this is added means you have to give a complete disclosure. When you say explanatory statement, see, you cannot give just small details and you can say that we are going for buyback. No, we should not do that. Law says these are the details which are definitely necessary. Okay. Full and complete disclosure of all material facts. The necessity for the buyback, why you go for buyback. The class of integrated deposit, which class is going to buyback. The amount invested under the buyback. So this is a buyback, which is going to get money to the investors. Okay. And the completion of buyback usually should be done within 1 year. See, in all the cases where a special resolution is passed, the special resolution will be valid for 1 year only. So within that you have to complete. So within 1 year from the date of special resolution, see in one provision we said that board resolution is sufficient, right? So board resolution. Okay. So that's about subsection 4. Is it okay? With respect to subsection 5, from whom we can go for buyback, this is often repeated question. Direct subsection 5 alone is asked from the existing shareholders, obviously from the existing shareholders, or in case other security holders means other security holders on proportionate basis you can do from the open market, which means what? You give like an advertisement, you give it, and anybody can come inside for buyback, for returning the shares, or by purchasing the securities issued to the employees of the company pursuant to ESOS or sweat equity. Is it okay? So these three cases. Subsection 6, you need to file a declaration of solvency. It's very, very important, especially it may be asked like a one word question or something like that. Declaration of solvency saying that if you're buying back the shares, what the creditor's headache will be, what they will be thinking is, in case if the company is not returning my money, see, even in the waterfall arrangement, who's preferred in the order? I'm not talking about equity preference shareholders and preference shareholders. I'm talking about who's preferred. Secured creditors, unsecured creditors, then only comes the preference shareholders and equity shareholders. See, in that waterfall arrangement itself, we are giving preference for creditors. Means when you go for buyback, creditors should not be made worried to go for whether they are thinking the company will be solvent or what, whether I'll be getting back my money. So they need to file a declaration called as declaration of solvency. To whom they have to file? To the register of companies, and if it is a listed company, to SEBI also. Not applicable if not listed. So only if it is listed company, you go to SEBI. And please make a note of it. Should be signed by at least two directors of the company. See, whenever it says two directors, and if a company, if my company is having one managing director, means definitely that managing director by default has to sign. This is how the act has to be interpreted. They'll say two directors or one director and CS. Tell me, or means what? You can take this one or this one now. No, this is not the way of studying. This is not English. This is law. How you have to understand this? This has to be given first preference. When there is a whole-time company secretary in your company, the whole-time company secretary and one director has to sign. If there is no whole-time company secretary, then what's the other option? Even though Act says or, that's why wherever we start the line, it will be mentioned as the company, the company, the company. Which means which company? It has a whole-time company secretary. Then whole-time company secretary was direct. So we need two signatures. One is this person, whole-time CS, and another director. If there is no whole-time CS in my company, then automatically two directors. Now apply the same provision. They say two directors, which means if my company is having managing director, then the managing director is the mandatory person to sign on it. The managing director and one and any other director. That one director will be passed with the board resolution, authorized by the resolution. Okay, so if there is any managing director, then managing director. Whether a manager can sign, whether a manager can sign, no. Managing director or manager may be by designation, name is different, may be by designation. See, law says if there is a manager, there need not be a managing director. If there is a managing director, there need not be a manager because they both stand at par at designation. But there is a difference in the status. Manager is an official person, okay, who holds office in a company. Managing director who holds as a board of director member because his name contains director. Now tell me, at least two directors has to sign. Whether a manager can sign, he's not a director, he's a manager. CEO, is he a director? Chief Executive Officer. How can you recognize this person as a director or not? Seeing the designation itself, you can recognize. Managing director, director. Full-time director, director. Executive director, director. Independent director, director. Okay, CEO, not a director. CS, obviously company secretary. CFO, not a director. COO, Chief Operational Officer. No, see, the name says they are other KMPs. KMPs means key managerial persons, but they need not be directors. So, easy way to recognize whether he is a director or not by the name, by the designation, how is being designed. Managing director, so it will end with director. Nominee director, small shareholder director, this director, that director. So, every name will contain director, director, director. So, in that case, when we say two directors, by default, if there is a managing director, the managing director will sign. If there is no managing director, any two director, any two is not any two, they should be authorized in resolution. Please make a note of it. Any two is not any two. Act says any two. But what? See, you might have held a board meeting, right? In that board meeting, you might have authorized two directors who has to sign the document. Whether opening a bank account or proceeding with any negotiable instruments, whatever it is, you have to give the director's name who can do this authorized act. So at least two director means it's not just at least it's any two, but managing director has to be here. If there is a managing director, any means not any, the persons mentioned in the authorized thing. Okay, resolution. So there's a prescribed format. It should be verified by an affidavit. Okay, affidavit in the sense that it's a declaration given saying that what it should contain, saying that he has made a full inquiry into the affairs of the company, and as a result, they have formed an opinion which is capable of meeting of his liabilities. See, this is about declaration of solvency. In the future, we'll meet out the liabilities. For how many years? Within 1 year period of time, we will not go insolvent. Which means within 1 year of time, we will definitely make up the liabilities. Is it okay? So if you are strong with this statement, then you can go for buyback of shares elsewhere. So this is with respect to subsection 6. And subsection 7, once it is done, you have to extinguish and physically destroy the bought back of shares or securities within how many days? 7 days of the last date of completion of buyback. Is it okay? With respect to subsection 8, please highlight, this is quite very important, please highlight no further issue of the same kind of shares or securities can be done, including allotment of new shares or other specified securities. We have already done with allotment, right? So if you are planning for allotment of new securities, you cannot buy back the same time within a period of 6 months. Okay, except we can go for bonus shares. Bonus issue is something it's a decision, so you can do it. In the discharge of subsisting obligations, like there are warrants and you're converting the warrants, you're liable. There is, as a company, you're liable to go for this ESOS or sweaty PD or conversion of loan. This and all is already your obligation, and you can do that. You cannot go for fresh issue for the same existing class of shares. Okay. So this is with respect to 8, 9. Accordingly, you have to maintain a register, and you should contain the shares or securities so brought and the consideration paid. Is it okay? And the date of cancellation of shares, date of extinguishing physically destroyed, other particulars as may be. With respect to 10, we have to file a return to the ROC and SEBI within how many days per? CMA Inter, please make a note of all these data. It will be helpful for you. Within 30 days of completion with prescribed particulars with respect to 11. If you are not following all these, then there will be a contravention. So you have to follow the penal liability. Okay, 1 lakh to 3 lakhs. This is both for company and officer in default. Okay. Not only that, you have to follow the SEBI provisions also. This is Companies Act liability penalty. With respect to, okay, buyback is done. How many subsections we have? Totally 11. So if you get a question, write a note on buyback of shares or what are the provisions covered for buyback of shares. I seriously request, if you're not strong enough, go another question. Okay. If you're strong enough, please write it. And please check the alternate. Alternate might be an easy one because you have to write all the 11 sections to cover the section 68 subsections. Okay, if you're strong enough, then you can maintain. Shall I go for section 69? Transfer of certain sums to CRR account, capital redemption reserve account. When the sources of buyback is from free reserves or securities premium account. What are the three sources of buyback? From free reserves, securities premium account, or from the process of the fresh issue of shares. Leave of the third category because you're issuing the shares and you're going to buy back. So that's not an issue. But these two sources, free reserve and securities premium, is something which should be going to the shareholders. Actually, when you talk about the shareholders, they are the notional owners of a company. They are not the real owners. They are the notional owners. What is the difference between real owners and notional owners? Real owners means, see, when we form a company, the company is different and we are different. Separate legal entity concept will be followed. We say notional owner, which means after the company owns up, ultimately you will get the asset. Okay. So you'll be called as a notional owner. When we list all the things, have you ever thought why we are listing free reserves on the liability side? Is the surplus accumulated by the company? To whom the company is proposing to give? To the shareholder. That's why it's put in liability. It's not in under assets. Okay. So free reserve, securities premium value, everything is all related to whom? To the shareholder, which has to be given. If there is surplus, if there is if there is money in free reserves, it has to be given to the notional owners. Now, what happens here is you are utilizing this for buyback of shares, which has to be now transferred to capital redemption reserve. Okay. How much to transfer? Sum equal to face value of shares bought back. You need not go for the premium. Only the face value of shares. And you have to clearly disclose in balance sheet. With respect to subsection 2, for what you can apply this value, application or reasons you are having this account for fully paying the paid up bonus shares, for fully paid up bonus shares. So that's about 69. This is often repeated section. Shall I go for 70? Prohibition for buyback in certain circumstances with respect to subsection 1, which company cannot buy back directly or indirectly through any subsidiary company, including its own subsidiary, cannot through any investment company or group of investment company, it cannot. And not only that, the C happens to be a basic default for a company. When there is a deposit, default in deposit. When there is a default in preference shares in redeeming. When there is a default in redemption of debentures. When there is a default in paying of this repayment of term loan, then definitely you cannot go for buyback. When we say deposit, either before or after the commencement of this act, not only the principal amount but also the interest amount. When we talk about preference shares or debentures, not only the principal amount, there is the main amount, includes the dividend also. Dividend, or when you say this one, interest. Okay. And when you say term loan to any financial institutions or banking company, repayment of principal and interest, proviso, please highlight. Usually you'll forget the last two lines. They're allowed to buy back if the default is remedied, which means what? Repaid, and the period of 3 years has lapsed. So probably there was a default in these cases. Okay. And at this time, at this period of time, at this particular date, they have repaid completely. The debentures closed. Everything is particularly closed. 1 year, 2 year, 3 years. After the 3 years, there should be a solid gap of 3 years. After they can go for buyback of shares, not before that. Okay. See, these are not to mention they want to maintain a proper solvency of the company. That's right. And if you're going for the buyback, means you have to clearly mention that within 1 year after the buyback, you'll not become insolvent. That we have stated already, right? So this is about subsection 1. Subsection 2 applicable only if complied with the provisions of 92, 123, 127, and 129. This is all related to financial statements and annual returns. Reason for buyback is an alternative mode, which is not there in the act, but usually from the judicial side, why do you need to buy back? Okay, what are the benefits if you go for buyback? It's an alternative mode for reduction in capital. You need not go for acquiring the approval from court or national law tribunal and all. You can directly go for reducing the share capital. Okay, you can improve the earnings per share. What do you mean by earnings per share? EPS. Okay, earnings per share. Okay, probably before buyback, the earning is 10 rupees per share. After buyback, the number of shares gets reduced. What happens is EPS increases. If EPS increases, the market value of the share will be increased. What is earning per share? Logically, by definition, you hold shares, how much you get. I'm not talking about return on investment. How much earning is there for one share? Okay. So, if instead of probably earnings by number of share, if the earning is 10,000 rupees, 10,000 crore rupees, and number of shares is 10,000 share, what is the EPS? 1 rupee per share. Okay. Sometimes it goes like 1.01, 1.02 and all. Okay. Just I'm taking a solid figure to understand easily. Now we have gone for buyback. What happens? Probably some 2,000 shares are bought back. Now the earnings is same 10,000. After buyback of shares, now the number of shares is reduced to 8,000. What happens to the EPS? Greater than 1. Because number of shares is reduced. So to improve the earnings per share, most of the company does that. And moreover, I have accumulated so much in my free reserves and securities premium. But what I'm going to do then? So I go for buyback. Okay. To improve return on capital, return on net worth, and to enhance long-term shareholder value, to improve an additional exit route for the shareholders. So when I think of coming out of the company, I can go for that. And also sometimes what happens is it will be thinly traded. It will not be densely traded. So that also I can come out of that. When it is thinly traded, what happens is I'll not get a good market value for my shares in the secondary market. So what I do is I directly give to the company. Okay. To enhance consolidation of stake. Okay. to prevent unwelcome takeovers. Beautiful point, pa. See, you people know what you mean by amalgamation. You people know what you mean by takeover. This is a normal thing. A company acquiring another company. Amalgamation also satisfies this definition. A company acquiring another company. What's the difference between these two? A company sits, that is both the director, both the management group sits, they have a coffee meeting, they have a dinner meeting, and they go for friendly amalgamating. Means we call this as amalgamation. When we say takeover, there is a company A, there is a company B. Company B will be taken over by A means it's not a soft move, it's a hard move. Might be this B company might be having a black mark like it's a negative aspect of the company. So if one company is taking over another, probably A will be the positive aspect, but B is losing its image. So and B company will be there. A company will be there, but amalgamation that's not the case. So we have amalgamation, we have a merger, we have takeovers. These are all conceptually looking like same, but logically totally different. So then there is B company, and A is a rival company planning to take over B. Okay, most probably how it takes over from the secondary market. To avoid this unwelcome takeover bids, what I do is because of this small shareholders holding small amount of shares, I buy back the shares from them. So if you are in trading, okay, if you are doing this share trading and all, then you go for buying the shares or you go for not buying. If you go for selling the shares, sometimes it will be law saying that the lot is reached because too much of selling of shares will go for unwelcome takeovers. That should not be done. It's not good for the company. It's not good for the life of the company. At one point of time, the company will be suffering from some other cases. So what SEBI does is it will have a limit on the trading of shares. That's what you call as quality trade. Okay. So seven, I have surplus cash. I want to return to the shareholders. So I redeem the capital. To achieve optimum capital structure, okay, see, I'll be having class A share, class B share, class C share with voting rights, with differential, so many class of shares which are not necessary. Probably during my investment or during the development of my business, I need it, but not now. So I go for planning the optimality. To support share price during periods of sluggish market condition, if it is having much of fluctuation, then I need to go for an efficient way and to serve the equity more efficiently. So if I have just two or three class of shares and the shareholders, and see we just noted this point, right? Calls on shares should be done on uniform basis. Not only calls on shares, also that's applicable for paying dividend also. So for Class A shareholders, I pay the dividend. Class B shareholders pay the dividend. Class C, I'm not worried about. What I do, I close Class C because unnecessarily I don't want to mess up with too many class of shares. That's not safe for the company. So these are the extra points. Now. Okay. Section 66, reduction of share capital, reducing the share capital. Simple by the heading. Subsection 1 says which company can go for reducing the share capital. Eligibility of the company limited by shares or guarantee and having a share capital. See, by default, a company having a share capital only can go for reducing the share capital. Okay. Please highlight the second point, subject to the tribunal's confirmation, which means the company can, they have to go for applying, then the tribunal has to confirm, then only you can go for proceeding. Need to pass a special resolution. Please highlight, fourth point is very, very important. They have to alter the memorandum of association by reducing the amount of his share capital and of his shares accordingly. If the company is having any arrears in repayment or interest payable on any deposits or whatever it is, then that company is not applicable or not covered under this eligibility. So probably you can just strike off this bullet point. Okay. This is falling under the rules. Methods or modes of reduction, often repeated question. Actually, let me go for this illustration. It's quite an easy illustration. Let me take the share capital of the company is, usually we'll get it in wording size. The share capital of the company is 10 lakh rupees, etc. I have taken as here as an equation format. How many number of shares are there? 1 lakh shares and face value 10 rupees. So 1 lakh shares into 10 rupees is 10 lakh. Okay. What's the face value? 10. For convenience sake, I'm taking the paid up value as 7, unpaid value as 3. Okay. In what way you can reduce the capital, share capital? First, law itself says this one. That is, it is there in the act. Extinguish or reduce on not paid up capital, unpaid value. How much you have paid this? 7 rupees. What is the unpaid value? 3 rupees. So your target here is to go on 3 rupees. Extinguish means what? Here after you have no liability. What does it mean? See, already the face value is 10 rupees. You have paid 7, which means you are still liable to pay 3. The law says you can extinguish, which means what? You need not pay 3 rupees. See, reduce 3 rupees unpaid value. Now the face value is becoming not 10 rupees. Now 7 rupees. It is becoming fully paid up shares. Okay. So paid up value 7 rupees. Unpaid value 0. Or what does it say? You need not completely extinguish the liability, but instead a part can be reduced. Which means reduce not the whole 3 rupees unpaid value, but only the 2 rupees unpaid value. So now the face value become 8 rupees. The paid up value is 7 rupees. Unpaid is 1. Earlier it was, this was the original state. Am I right? Now, instead of this 3, what they are doing? They are reducing 2, which means only 1 rupee is liable. 7 rupees already paid. Then 7 plus 1 is 8 rupees becomes the face value. So obviously this is going to alter the MOA, am I right? This was the MOA, right? Now it becomes 8. Or in this extinguishing case, it becomes 7. So that's why we have to alter the MOA. This is the first method. Shall I take over? Let me finish it off. Let me clean the board. Actually, we have two major methods. Actually, three methods. But as per the act, we say one method and this is second method. Same extinguish or reduce. This is on not paid up value. This is on paid up value. This we have done. Now go for on paid up value. Either we can cancel. Paid up means what? I have paid under the paid up capital. Either I can cancel or pay off. Cancel means lost or underrepresented by available assets, I can cancel. I have the assets worth 1 lakh. What I'm doing? I'm cancelling the 1 lakh rupees paid up value. Now the face value becomes 9. How? Because the paid up 7 is now cancelled for 6. I'm paying back the 1 lakh. That is 1 rupee. So it becomes 6. See, we are not touching the unpaid capital. The first mode is, see, the first mode here is on unpaid value. There will be touching only the unpaid values. Here what we are doing, we are touching only the paid up values. So paid up is 6, unpaid the same 3 only. What happens to the face value? 9. Or pay off the excess of the wants of the company. So there's a profit of, see, this is with respect to assets, this is with respect to profit. The content is same. I have an assets, I'm just pulling up all the assets. What the company is going to do with assets? Okay, we have 10 cars. You're going to travel each day by one car. Okay, அது கொஞ்சம் கேக்குற மாதிரி இருக்கு. You have 10 houses. What are you going to do? You have 100 houses, each in one different place. Okay, see, you have assets. What the company is going to do? Okay, so what is planning is that asset, if it is, see, I am giving a small example for 1 lakh. It need not be 1 lakh. It can be any denomination. It can be 1.5 lakhs, but I am planning for 1 lakh. It can be of any value. The same thing, there is a profit for 1 lakh. Ultimately, what I'm going to do with the profit, I can give it as dividend, or I can transfer to surplus, put it in free reserves, or I can utilize for the future for paying the bonus. Why I'm going to go for such a lengthy procedure? Let me finish off, close now itself. Ultimately, the shareholders will be happy, right? So what I'm planning, this profit 1 lakhs, I can reduce the paid up value, which means I'm giving back the paid up value. Now it is 6 rupees. Unpaid, I'll not touch with the unpaid. Same thing. Okay. Face value now reduces to 9. Still in both the cases, what you do? We have to alter the enrollment. Okay. So we have totally, whenever you go for reducing the share capital, you need to get the confirmation from the tribunal, which means the company will go for applying and the confirmation will be given. So that's why they start as subject to. Subject to confirmation by the tribunal or an application by the company, a company limited by shares or limited by guarantee and having a share capital may by a special resolution reduce the share capital in any manner. Any means not any. Okay, you have to understand. Any means only by this manner. Okay, by any manner, and in particular may. First point. Actually, two methods. These are the methods. Okay, these are the methods. Method A, method B. Under method B, first point, second point. First is related to assets, that is assets available, and second one with respect to so extinguish or reduce the liability on any shares in respect of the share capital not paid. So this is with respect to unpaid value. Second, either with or without extinguishing or reducing liability of any of its shares, cancel any paid up share capital or pay off any paid up share capital which is lost or is underrepresented by available assets or which is in excess of the wants of the company. See, if it is assets which is giving back to the shareholders, then it's fine. But when it goes with respect to profit, it's first who's having the right over the profit means definitely the company. Obviously, the preferred shareholders, because it's mandatory for them to give the interest. But for the profit, the first person having the right is the company only. Because if the company wants to utilize the profit for its own business expansion, means it will utilize it. Or it can give it as dividend, or the other mode is here where it can utilize for paying the paid up value. Is it okay? Alter his memorandum by reducing the amount of share capital and of his shares accordingly, provided no such reduction shall be done in case there is an arrears of repayment of deposit asserted. Okay. Shall I take over? With respect to subsection 2, notice by the tribunal of every application should be given to the central government, to the registrar, if it is a listed company, SEBI, to the creditors of the company, and what they'll do is they'll consider the representations, if any, which has to be made within 3 months from the date of receipt of notice. They'll check whether they are receiving any representation because reduction of share capital means in future if the company is not unable to pay the assessments, what happens? You should not go for installment position, right? That's what. Proviso, if no representation is made, it is presumed as no objection. You understand the meaning there? It's not assumed, it's presumed. Which means law says you can take it for granted. So you need not check. Okay. Subsection 3, for the tribunal. See, after going all these things, tribunal now order the confirmation or the reduction as such terms and conditions as it deems fit. You may be planning for 1 rupee on reducing unpaid value of this one, but the tribunal may be giving some other values. So it will check for the conditions on the satisfaction of that claim or debt or claim received by every creditor, and they'll check whether it can be discharged or determined or secured or some consent may be given. Okay. Provision no sanction unless it has to follow with the accounting standards and all as in conformity, and certificate has been given by that effect to the company's auditor. So company auditor will give the certificate that we have filed everything and we have gone to the accounting standards and all and everything is fine. Okay. With respect to subsection 4, publish the tribunal's confirmation order as directed by the tribunal. With respect to subsection 5, you have to deliver a certified copy of the order and a minute approved by the tribunal to whom? To the registrar within how many days? 30 days. CMA students, please focus. Data related question. Okay. Within 30 days of the receipt of the copy of the order, receipt of the not order, copy of the order. Okay. What are the contents to be? Amount of share capital, number of shares into which it is divided, amount of each share, and the amount, if any, at the date of registration deemed to be paid upon which. Okay. And the registrar will register all these things and it will issue a certificate to that effect. Shall I continue? Subsection 6. Nothing in this section shall apply to buyback. We have already done that in section 16. Okay. So, subsection 7. Non-liability of a member, past or present, with respect to any call or contribution made in this means he is not liable exceeding the amount of difference. Okay, the amount paid on the share or reduced amount and the amount fixed by the order of redemption. So it's not liable. See, you say face value is now 9 rupees, which means what? You're not liable for that 1 rupee. That's what they mean, right? See, in this example, it has to be clearly stated, right? யாரோ கம்பெனி கிட்ட வந்து கேட்டக்கூடாது. இப்போ நீங்க வாங்கிப்பீங்க நாளைக்கு கேட்க மாட்டீங்களான்ட்டு. ப்ளீஸ் அண்டர்ஸ்டாண்ட். இப்போ திரும்ப கொடுக்குற மாதிரி கொடுத்துறீங்க நாளைக்கு கேட்க மாட்டீங்களான்னு நிச்சயம். The company should not face this much of a case. See, earlier the company was having the face value as 10, but now what happens? 9. Which means what? In future, the company should not increase this to 10 hereafter. That's why they say here. Okay. What's the paid up value? Earlier it was 7, now it is 6. The unpaid value is 3. What happens here is the shareholder will be asking, instead of reducing the 7 to 6, why not you reduce 3 to 2? Which means what? Why not you go for this move? Okay. Let me continue. Where is over here? So that's about the amount paid on the share or reduced amount which have been deemed to have been paid minus fix the amount of the share ordered by the fixed by the order of reduction. For this amount, the member is not liable. With respect to subsection 8, by the name of any creditor, in case he is making any representation which is objecting to the reduction of share capital by reason of his ignorance or reduction of nature to that effect, it's not entered on the list of creditors. Actually, we make a list of creditors who is eligible for this one. And after such reduction, the company commits a default, means then with respect to this amount, he will be penalized. This is covered under insolvency in bankruptcy code, not under Companies Act. Most of the provisions are converted to this one. So what happens is they'll check whether the company has commenced winding up on the day immediately before the said value, or the company is wound up, commenced winding up. Here is wound up because the tribunal has said, and the creditors are applied for it. Okay, you need not worry about this section because I have to go for referring IBC code. Okay, it's out of your scope. Okay, so you can comfortably leave off this one. Then with respect to subsection 9, actually following subsection 8 only shall affect the rights of the contributories also. Subsection 10, yes, if you are not following, then you are liable under criminal liability. Section 447, to whom this is applicable. Please understand, criminal, if you go for section 447, is not applicable for everybody. It is clearly mentioning for any officer, okay, who knowingly conceals the name of any creditor. Knowingly means what? Wantedly he does that. He knows that his name is not listed in the creditors list. But he knows, but he is not mentioning that. Okay, so knowingly conceals the name of any creditor who is entitled to object. Knowingly misrepresents the nature or amount of the debt of that persons, or abates or privy to any such concealment or misrepresentation. What do you mean by abating? Actually, I am not doing it. Others are doing it and I am along with them. Others are pannaran. You cannot escape. Okay. So that's about, actually you have 10 subsections now. And this one question is often asked. Let me finish it off. A comparison between reduction and diminishing. Often repeated question. Whenever we use the term reduction, probably if you go for the English meaning, diminishing means diminishing. It looks like as if we are removing that. But what law says is reduction is different and diminution is different. Diminution means we are working on the authorized capital, but whereas reduction means on issued capital. Just remember, a company has, ABC company has 15 lakh as authorized capital, which means a nominal capital. This is mentioned in Memorandum of Association. Now, what the company thinks is, instead of having 15 lakh shares as authorized capital, not issued, let me reduce it to 12 lakhs. Probably the issued capital may be 10 lakhs. See, among the 15, the issued capital is 10 lakhs. Not issued, not subscribed is remaining 5 lakhs. What the company thinks is, instead of having this 5 lakhs, let me have 2 lakhs, which means it's diminishing 3 lakhs. You cannot use the word reducing. See, you're not future accountants, Park, you should be very careful. You should not use the word reducing here. In normal English language, it looks like diminishing. Sorry, it looks like reducing, but you should not use reducing. It is diminishing. Diminishing means when we say memorandum of association and when we talk about this capital clause, we say that the company is authorized to issue only this shares, right? And when we say 3 lakhs is diminished, which means only 12 lakhs is the authorized capital. We are not talking about the 3 lakhs. We see as if there is nothing provisions related to 3 lakhs. When we say reduction, it's on issued capital because you are playing on paid up value, face value, and everything. Here we call it as reduction. Both the cases will go for alteration of MOE. Okay. Here there are 3 methods. As there is no such method and all, creditor consent is required because already issued, right? Here there is no such concern. Here we need to have special resolution and court approval is required. Here No court required, no court approval required, ordinary resolution is sufficient. You may ask me, ma'am, why the company has to diminish this 3 lakh form? Reduction means we have seen so many reasons. The company has assets, the company has a profit, excess of reserves are there. So, okay, the company is reducing. Why we need to go for diminishing? Because each and every time when the company goes for filing of forms, depending on the authorized share capital only, it will be calculating the form fees, prescribed fees. So each and every time when I have this 15 lakhs, I'll be actually it will not be like because of 1 or 2 lakhs, it will not making a big difference. It will be mentioning as up to 15 lakhs, 15 lakhs to 30 lakhs, 30 lakhs to 50 lakhs. It will be mentioned as this. So what happens here is up to 15 lakhs is not an issue. If my company is having 15 lakhs as share capital, authorized share capital, I'm reducing 2 lakhs. It's only extra work. Probably the company secretary is not having any job in the company. Okay. That's why it's planning. Okay, ஏதாவது வேலை பண்ணும் சம்பளம் வாங்குறதுக்கு. Okay, nobody will plan that. In case the company is having 20 lakhs as authorized capital, but seeing the prescribed fees, it says that up to 15 lakhs is one fee. Above 15 lakhs to 30 lakhs is another fee. I'm not going to use 5 lakhs at all in my future. So what I plan, I reduce it to 15 lakhs, which means I should not use reducing here. I should use diminishing. The normal English language should not be applicable. So future professional ஆன பிறகு you don't use the word reducing, you use the word diminishing. Definitely நீங்க எங்கேயாவது ட்ரைனிங் போகும்போது diminish பண்றோம்னு சொல்லி பாருங்களேன். அப்பா ஆக்ட கரைச்சி குடிச்சிருப்பாமா சொல்லுவாங்க. Really that this has happened. Okay. So because to say this fees amount, what we'll do is we will diminish it. Is it okay? So that's about section 66. Probably the next heading we'll discuss in the next class. Thank you, but thanks for joining.